Hi, it's John at Brotherton Accountants in Redditch. Today I just wanted to do a quick demonstration on what a director's loan account is and an overdrawn director's loan account. So it is amazing how often we get asked this question, and I just thought it would be a good idea just to post a quick video just showing exactly how the director's loan account is transacted. Nice simple way of doing it is just with some T accounts, just hopefully, or just be a great way of explaining exactly how everything operates. It's not difficult, it's just, you know, we do get asked the question a lot, so I just thought it would be a great way of just explaining it quickly. Okay, so if we've got a scenario, we've got a director set up a company and they want to put £5,000 of their own money into the company bank account. We would be saying there's £5,000 going into the company bank account of the director's own money, so that is a transaction that would get credited to the director's loan account. So in theory there now we've got £5,000 going into the company and the corresponding entry is £5,000 against the director's loan account. So before we did that, there was a zero balance on the loan account. Now we put £5,000 of our own money into the bank account, and so we're now owed £5,000. So on the balance sheet of the company we've got the asset of bank, so the asset of cash, the money in the bank has gone up by £5,000, and the corresponding credit on the balance sheet is current liability, which is the director. So the director now is a creditor of the company, and that is in theory what a director's loan account is. It's just money that's been transacted through the director's loan account, so money that the director, his own money, is used to fund transactions within the company. So moving on from that, if we've got a director's salary, so we might run £950 through the payroll in the company for the director because it's tax efficient to do it. The director can use up his personal allowances within the tax year, and we get tax relief on that in the company. Now it may be, if that was transacted and the director took the money out of the company, then that would be the transaction dealt with, and it wouldn't be transacted through the director's loan account because the money would be coming out of the company bank account. In this instance, if we're saying there's £950 gone through the payroll but the director doesn't actually want to take it, he wants to leave it within the company as working capital, then in that scenario we've got £950 that we need to credit the loan account, because we've got £950 going through the P&L as director's salary, and now we've got £950 that the company director is owed. So our balance has now gone up to £5,950 owed. So the company now owes the director £5,950. In January we may have done 1,000 business miles, so if we're claiming 45p a mile, so we can claim up to 45p a mile for the first 10,000 miles in a 12-month period. So we've claimed that £950. Again, the company director has funded that fuel through his own pocket, so he's used his own money to pay for his fuel, and he hasn't had the money from the company for that £450. We would be netting that as a credit to the director's loan account. So now you can see the rolling figure on the director's loan account is now up to 6,400. The end of January we may say, well, we need to take 2,500, so the director may say I need 2,500 to live, so we're taking 2,500 out of the bank account, and then we're netting the 2,500 off against what is owed. So in that scenario now, before we took the 2,500 out of the company bank account for the director, we've got a scenario where he was owed 6,400. We take 2,500 out at the end of January. The director is now owed 3,900. So it's all about just having this rolling balance that is the director's loan account. In February we may have done 2,000 business miles, so we've got £900 at 45p a mile, so we've got £900 that we're claiming. Again, the director's used his own money to fund that £900, so we credit the loan account. So now our figure on the loan account is going to go from 3,900 owed by the company to the director up to 4,800. So we've got this rolling figure keeping moving. We may take out so that may be the only transaction that's gone through there. In February we may take out, say, £3,000 in February. So we've taken £3,000 out of the bank account in February, and we're net debiting the loan account, so we're netting off against that. So now our figure on the loan account is sat at £1,800. So before we did that, before we took the £3,000 out of the company, we were owed 4,800. We're now owed 1,800. Okay. Now in March, again, we might have another 950 going through the wages, and again the director hasn't taken the money out, so we credit the loan account. So we've now got a figure of 2,750 that the director is owed. And in March as well, we may have brought £100 worth of stationery, again out of the director's own pocket. So we've got £100 that we would credit the loan account. So our rolling figure now is 2,850. Now if we want to then take out in March £2,000, so we're saying, right, the director now needs £2,000 to live for March. We're going to take it out of the company bank account here, and we're going to credit it, debit it against the drawings that the drawdown, the expenditure that we've put through the director's loan account. So we've got a rolling figure of 850 owed by the company to the director. Now in March, that may be that we've taken £4,000 out. Now if we did that, we'd be in a scenario where all of a sudden we've got an overdrawn loan account, so our figure is £1,150 deficit. So all the credits that we've credited here have been taken out, and an extra £1,150. So that's where the terminology comes in of an overdrawn loan account. So if we go back to where we were before we took anything out in March, we were owed 2,850. If we took 2,850 out, our balance would be zero. If we took 2,000 out in March, we would be owed 850. Obviously in that scenario we're taking 4,000 out, so we now owe the company 1,150 because we've actually taken out more than we've got as credits on our loan account. So there are tax implications of that, so this is, it's key to try and keep this number within a credit, because we want to stay as a creditor of the company and not a debtor. Like I say, there are tax implications of going overdrawn on your loan account, because it basically means you're using the company's money for your own personal transactions. So that is something that this is where as accountants we would keep a close eye on the levels on the loan account, as our clients are aware. So I'm hoping that has explained where we are with the loan account, and it gives you just a bit of an insight to what's going on there. I know it's not difficult, but it is a question that we do get asked all the time, so I thought it would be a good little video to do. Okay, thanks very much. Thank you. Bye.